What is insurance? Let us first understand what is insurance. Insurance is a mechanism whereby the insurance company organizes the process by which the unfortunate few who suffer losses share the burden with many who are exposed to risk of similar losses. Such burden would include the primary burden of direct losses like damage due to fire and indirect losses like loss of production following such damage. It also includes secondary burden like physical and mental strain caused by anxiety of probable losses and the cost of maintaining reserves to mitigate such losses if they occur. Insurance, therefore, is a pool of funds to which many who are exposed to similar risk contribute. Such contribution is called premium. If anyone who has made such contribution suffers monetary loss because of such risk, that person recovers such loss from the pool. This recovery is called claim. Why insurance? As we discussed, the purpose of insurance is to make good the financial losses suffered by the insured due to loss or damage to assets having some economic value owned by him. Imagine there is no insurance. In that scenario, no one would risk investing huge amounts of money by way of capital into industries, infrastructure, etc., for fear that if the assets created by such investment are lost or damaged due to any risk they are exposed to, like, say, fire, earthquake, etc., their entire investment would be lost. Because insurance provides financial protection in the event of such losses, entrepreneurs come forward to invest in various enterprises. Insurance, therefore, guarantees investment and is thus a facilitator of economic growth. Is insurance a contract? We all know that a valid and legally binding contract has to have the following: offer and acceptance, consideration, mutual agreement, legally known as consensus ad idem, meaning all parties involved are of the same understanding of the issues involved, legal competency of each party to the contract. Like any other contract, insurance contracts are also subject to these prerequisites. Offer happens when a person interested in taking insurance makes an offer to the insurance company by providing details in forms prescribed for this purpose. This person interested in taking insurance is known as proposer, and the form through which she or he provides details is called proposal form. Acceptance occurs when, after going through the contents in the proposal form and analyzing the same, the insurance company accepts the proposal and provides the proposer with the terms of insurance, like what are all covered, known as scope of cover, what are not covered, called exclusions, amount of premium payable, other conditions of insurance, etc. Consideration is the premium paid. On payment of premium by the proposer and acceptance of the same by insurance company, the proposer becomes the insured. Agreement between parties, consensus ad idem, is achieved through contents of the proposal and policy wordings. As a corollary, insurance contracts where coercion, undue influence, fraud, and or mistakes in understanding occur are held to be void, not enforceable, or voidable, enforceable only when both parties agree. Legal competencies of parties like proposer being a major and legality of the contract being enforceable in law as it prevails also apply. For instance, a robber cannot insure his booty for the risk of being caught, nor can a smuggler insure the smuggled goods. How is insurance contract different from other contracts? Normal contracts follow the principle of buyer beware, known as caveat emptor. The person who makes an offer will merely make the offer. The person who accepts the offer is expected to satisfy himself or herself by finding out whatever information or details he or she requires about the offer being made. The responsibility to do so is on the acceptor. Insurance contracts are, however, governed by the principle of utmost good faith called uberrima fide. Here, it is the responsibility of the offerer, known as proposer in insurance, to provide the insurance company, who is the acceptor, all material information about the offer, as the offerer or the proposer alone knows what is being insured. Failure by the proposer to do so will render the insurance contract void or voidable.